Chasing Wisdom Podcast.
Yeah. This is Chasing Wisdom. Real life, real money, real faith. I came up with a prayer and a plan. Kept my name on the line. This is Chasing Wisdom.
Real life,
Real money.
real faith.
I've been counting every step. Now I'm pressing through the noise. Hands up when the truth hit. I was built for this choice. This is Chasing Wisdom.
Real life,
Real money, real faith. Fade it out, then cut it clean. Chasing Wisdom.
What up? How y'all doing? I am Rodney Lawson, and this is Chasing Wisdom Podcast. I'm glad y'all came and locked in. This is a podcast to learn about building wealth, making money, fixing credit, using credit, talking about Jesus Christ, loving Lord, loving God, being blessed, and just getting wisdom. We chasing the highest power. We chasing the highest knowledge. We want wisdom. We want to chase it. We want to get it. We want to obtain it. And we want to invoke it into our lives to the point that we get to the higher level. We get to the higher level of life. We want to live life how we want to live. We want to be what we want to be. We want to be happy. And we want to spread it. We want to spread it like a virus. This is for everybody who's looking to learn about wealth and build wealth and learn about spirituality and build spirituality, because at the end of the day, we can get it, but we can't take it with us. And when it's done and over, we got to know where we're going, So Jesus Christ first, family second, and let's get this wealth and take care of this family that Jesus Christ blessed us to have. This is Chasing Wisdom Podcast. I am Rodney Lawson, your health and your game dropping advisor. Yeah. You know what I'm saying? So today we're going to talk about building generational wealth using the buy, borrow, die method. You know what I'm saying? Without paying taxes. We're going to build this generational wealth without paying taxes. I give you the game on the taxes all the time. I'm helping you out. So, without further ado, we're going to get right into it. The wealth generational code the ultra rich live by. So, why the wealth play a different tax game? You know what I'm saying? Why they doing this? We're going to break it down. The wealthiest people in America do not primarily earn W-2 income. They accumulate appreciating assets and use the tax code to defer, reduce, or eliminate tax liability entirely. While the average worker pays income tax on every dollar earned, an asset owner can hold appreciating stocks or real estate for decades without triggering a taxable event. Excuse me, y'all. The IRS only taxes realized gains, not unrealized ones, which means paper wealth grows completely tax-free until you sell. Understanding this fundamental difference, earned income versus asset appreciation, is the first mental shift required to think like a wealthy person once you see your net worth grow as a tool rather than a paycheck. The entire buy, borrow, die strategy becomes logical and elegant. So unrealized appreciation is the most powerful tax shelter available legally. grow assets without selling them, and you owe nothing to the IRS. Now, there's three pillars: buy, borrow, and die. The buy, the borrow, the die strategy operates as three-phase wealth cycles that repeat and compound across a lifetime and across generations. In the buy phase, you acquire appreciating assets, stocks, real estate, business, or index funds and hold them without selling, allowing compound growth to work untaxed. In the borrow phase, you use those assets as collateral to take out loans, receiving cash you spend on lifestyle investments, your expenses without it being classified as taxable income. In the die phase, your hires inherit your assets as a stepped up cost basis, meaning the accumulated capital gains from your lifetime of appreciating are wiped out entirely at death, legally and permanently. This strategy is not a loophole or trick. It is a deliberate use of three separate provisions in the United States tax code that work together like gears in a machine. When you understand all three phases, you stop seeing taxes as inevitable and start seeing them as optional for asset owners. So the buy, borrow, die works because each phase leverages a separate tax code provision. Together they allow wealth to grow, be assessed, and transferred with minimum to zero tax. So I hope y'all caught that. You know what I'm saying? You buy the asset, you hold the asset and let it accumulate and grow without it being taxed. Then you take out loans on this asset while you're alive for your lifestyle. You know, you take out loans. Now, when you die, this is the trick. Your hires inherit your assets at a stepped up cost basis, meaning the accumulated capital gains from your lifetime of appreciation are wiped out entirely at death, legally and permanently. This is a loophole and is deliberate use. So they'll inherit the stock or whatever it is, the asset, and this is going to keep the money growing. And whatever you did in your lifetime is just going to step up the cost basis. You know what I'm saying? But the asset is still going to be passed on and building and building and building and building in the family. You know what I'm saying? So you building wealth without, you know what I'm saying, losing it. Now, is this legal? Understanding the tax code is provision behind the strategy. You know what I'm saying? So, a common reaction to buy, borrow, die is skepticism. You know what I'm saying? Surely the government would have closed these loopholes by now, right? But these are not loopholes. They are intentional provisions written into the Internal Revenue Code that have survived decades of legislative review and deferral of capital gains until a sale of event is confined under IRC Section 100I, which requires realization before recognition. This step-up basis at death is governed by IRC Section 1014, a provision that has been part of the federal tax law in various forms since 1921. Borrowing against assets to generate non-taxable cash is simply a structural feature of debt. Loans are liabilities, not income, and the IRS has always treated them as such. Wealthier taxpayers have teams of CPAs and tax attorneys who ensure these strategies are executed within the law. And there is no reason a well educated individual investor cannot do the same with proper guidance. Understanding the statutory basis of each phase removes the fear and gives the confidence to implement it. The buy, borrow, or die strategy is built on three long-standing provisions in the U.S. tax code. It is entirely legal and has survived decades. So understand, the congressional been reviewing it and it's been surviving. It's legal. They cannot tax debt. So understand the game. They can't tax debt. You get the asset. You bake a loan on the asset. They can't tax debt. Understand it. When you die, the cost basis goes up, pass on to your heir. You know what I'm saying? And you just rinse and repeat. And as it accumulates and appreciates and becomes worth more and more and more, like stocks and things, well, the wealth stays and builds and grows. And hey, you get wealth, you know. But anyway, let's get back to it. Who can actually use this strategy? Setting realistic expectations. While the buy, borrow, die strategy is associated with billionaires like Elon Musk and Jeff Bezos, it is accessible at much lower wealth levels with some modifications in approach. The borrowing phase requires lenders to accept your assets as collateral, which generally becomes practical once you have at least 250,000 to 500,000 in taxable brokerage account or significant real estate equity. However, the buy phase, acquiring and holding appreciating assets, can and should begin immediately at any income level. Because the time in the market determines how large your collateral base becomes, real estate investors can begin leveraging the borrowing principle throughout cash out refinancing at much lower net worth thresholds, sometimes with as little as 50,000 to 100,000 in home equity. The die phase benefits from the estate planning tools that require action regardless of current wealth levels, and starting early gives you decades to structure your estate correctly. This strategy is not a fantasy reserved for billionaires. It is a framework that scales to meet you where you are. The buy, borrow, die strategy scales to multiple wealth levels, with the buy phase ultimately and the borrowing phase, with the buy phase immediately and the borrowing and estate planning phase become available as your asset base grows. So you can buy immediately, and then as your asset grows, as you hold it and it grows and becomes worth more and appreciates, that's when you can begin to borrow against it. Okay? Now, choosing the right appreciating assets. Not all assets qualify equally for the buy, borrow, die strategy. The ideal asset must appreciate reliably over long periods, be acceptable as a loan collateral, and generate minimum taxable income during the holding period. Publicly traded stocks and broad market index funds are among the most efficient assets for this strategy because they grow tax-free until sale, are universally accepted as brokerage collateral, and incur no annual tax on unrealized gains. Real estate is the second most powerful vehicle, offering appreciation combined with depreciation deductions and the ability to pull equity through refinancing without a taxable event. Businesses and private equity stakes also qualify but are harder to use as collateral and involve more complex valuation. Dividend heavy stocks, while popular, create annual taxable income that partially undermines the deferral strategy. So, growth oriented assets with low or no dividends are generally preferred during the accumulation phase. The goal is to build a portfolio that grows significantly over time while generating as little current taxable income as possible. So choose appreciating assets with low current income. Grow index funds and real estate are the workhorses of the buy phase because they compound tax deferred. So you want to get an asset that's going to appreciate but not cause you to get taxable income. You don't want the tax on it. So something you can buy and hold but won't cause a tax event unless you sell it, like stocks or real estate, something like that. You know. All right. Account structure, where you should hold assets, does matter. All right. The account in which you hold your appreciating assets determines whether you can borrow against them and how they are treated at death, making account structure one of the most critical and most overlooked decisions in the buy phase. Assets held in taxable brokerage accounts can be used as collateral for securities backed loans and receive a stepped up basis at death, making taxable accounts the primary vehicle for the full buy, borrow, die strategy. Assets inside traditional IRAs and 401ks cannot be pledged as collateral, do not receive a stepped up basis at death, and are subject to mandatory distributions, all of which limit their usefulness for the specific strategy. Roth IRAs offer tax free growth and can pass the highest tax free, but they also cannot be borrowed against, placing them in a supporting rather than central role. Real estate held in your personal name or in a properly structured LLC can serve dual roles as a collateral asset and a income producing vehicle while still qualifying for stepped up basis treatment. This strategic investment deliberately allocates assets across account types based on the specific tax outcome desired, not simply for convenience. So hold primary appreciating assets in taxable brokerage accounts. They are the only account type that enable both the borrow and the die phase of the strategy. So you got to hold them in that account and you got to be able to borrow against it and use it as collateral. You see what I'm saying? So all of this matters. The account you holding the asset in, the type of asset you choosing, all of this matters, y'all. So pay attention to what you're getting and what you're doing. Because if you're trying to implement the buy, borrow, die strategy, all this stuff accounts. You know, they got stuff that they tell you to do and they say, oh, it's a good idea. And it don't have the right structure for this specific strategy, you know, like a regular IRA. I mean, yeah, it's tax free. I mean, yeah, it's an asset, right? But it makes you have to mandatory deduct from it, which means it's taxable. So you can't really, you know, boom. Now, the power of not selling. Tax loss, harvesting, and rebalancing without triggering gains. One of the discipline challenges of the buy phase is managing a portfolio without triggering taxable sales, which requires learning alternative techniques for portfolio maintenance. Tax loss harvesting is the practice of selling depreciated positions to realize a tax loss, then immediately reinvesting in a similar but not identical asset to maintain market exposure. generating a tax deduction while keeping your wealth. The strategy can generate thousands of dollars in annual tax deductions that offset other income. While your overall portfolio continues to grow, portfolio rebalancing, which traditionally involves selling overweighted positions, can be accomplished without taxable sales by directing new contributions towards underweight assets or using dividends to purchase underweighted positions. In taxable accounts, you should evaluate every potential sale through the lens of after tax return. The question is the question never is the position up, but rather does selling here after taxes leave me better off than holding and borrowing. This discipline of never selling without compelling after tax reasons is what separates ordinary investors from those who successfully execute this strategy over decades. So, tax loss harvesting lets you generate tax deductions without exiting the market. Use it to offset income while maintaining your full investment position. So, you gotta make it look like you ain't gaining, you know what I'm saying? You gotta play with the money, play with the asset. Now, real estate as a biphase asset, appreciating plus depreciating. Real estate offers a unique dual advantage in the biphase. It appreciates in the market value over time while simultaneously generating paper depreciation deduction that reduces taxable income, creating what some tax professionals call phantom losses. The IRS allows residential rental property to be depreciated over 27.5 years and commercial property over 39 years, which means $500,000 rental property generates roughly $18,000 per year in depreciation deductions, regardless of whether the property actually declines in value. These depreciation deductions can offset rental income, reducing or eliminating the tax liability on rent collected, which is particularly powerful when combined with the strategy of keeping properties long enough to benefit from appreciation. Real estate professional status available to those who spend more than 750 hours per year in real estate property trades unlocks the ability to use rental loss against ordinary income, a significant accelerator for high income earners. Additionally, when a property is sold and a new one purchased using the 1031 exchange, capital gains taxes are deferred indefinitely, allowing equity to compound across multiple properties without triggering a taxable event until death, at which point the stepped up basis eliminates the accumulated gain entirely. So, y'all heard that? Y'all heard it. Real estate provides appreciation and depreciation deductions simultaneously, and 1031 exchanges allows you to defer all capital gains indefinitely until the stepped up basis at death eliminates them entirely. So that's how you keep that wealth flowing without paying the taxes. You see? You see the wisdom. We giving it to you, man, for the free. Oh my gosh. Man, y'all make sure y'all like, share, subscribe, and lock in with Chasing Wisdom Podcast. I am Rodney Lorston, your money managing host, your game dropping host. I'm giving you the game, the sauce, the juice, whatever you want to call it. I got it. Come get it. You did. All right, back to it. While loans are not income, the tax logic of borrowing. Now, I already told y'all that you can't tax debt. But anyway, let's get into it. The foundational principle that makes the borrow phase work is straightforward but profound. Loan proceeds are not classified as income under the U.S. tax law because they must be repaid, creating a liability that offsets the asset received. When you receive a paycheck, you receive cash with no corresponding liability. That income, and it is taxable. This is income and it is taxable. When you receive a loan, you receive cash, but also take on an equal obligation to repay. So your net worth technically does not change at the moment of borrowing. This is why the IRS does not tax mortgage proceeds, auto loan proceeds, or business loan proceeds. They are not income events. The strategic insight of the borrow phase is using this basic accounting principle deliberately and at scale. Borrow large sums against appreciating assets, live on those proceeds, let the assets continue to grow at the rate that exceeds the loan's interest, and never sell. The interest paid on those loans may or may not be deductible, depending on how the borrowed funds are used. But even without a deduction, the strategy creates massive tax advantage compared to selling the underlying assets and paying capital gains. Loans are not income because they are repaid. This basic accounting principle is what makes strategic borrowing against appreciating assets a legal tax-free source of spendable cash. So you see, what you do is you just get the asset. You know the asset is going to keep going up and appreciating. So the value is going to go up and up and up. You take that asset, you borrow against it, you use it as collateral, and you live off this money. And while living off this money, of course, make your payments, you know what I'm saying? Making sure this asset is growing enough that it's going to make more money than what you're paying on the loan. And when you die, it all goes away, basically. It all goes away. All right. Security backed lines of credit, how wealth investors borrow against stocks. All right. A securities backed line of credit, also called a pledged asset line or margin loan, allows the investor to borrow against the value of taxable brokerage account without selling the underlying holdings. Major brokerages include Charles Schwab, Fidelity, Merrill Lynch, and Morgan Stanley offer these products, typically allowing borrowing of 50 to 70% of the account's value. For diversified portfolios of stocks and bonds, interest rates on these products are generally much lower than the credit cards or the personal loans, often range from 1 to 5% above the benchmark rate because the loan is fully collateralized by the investment account. The primary risk of this approach is margin call. If the value of your collateral drops significantly due to the market decline, the lender may require you to either deposit additional assets or repay part of the loan immediately. Managing this risk requires maintaining a conservative loan to value ratio. Ideally, never borrowing more than 30 to 40% of your portfolio's value and keeping liquid reserves to cover potential margin calls without being forced to sell assets at depreciated prices. When managing prudently, a securities-backed line of credit is one of the most tax-efficient ways to convert paper wealth into spendable cash. So keep your borrowing at 30 to 40% of your portfolio's value to maintain a safety buffer against the margin calls and protect your ability to hold through market downturns. That's a good little play, but I wouldn't. I don't know. I would, but I wouldn't. You gotta stay at the 30 to 40%. That's the thing that bothers me. So, if you feel like you can do that, that's for you. That's not for me. Nah. All right. The cash out refinancing, real estate version of tax-free asset. For real estate investors, the equivalent of a securities-backed line of credit is a cash out refinance, which allows property owners to borrow against the buildup of equity in their real estate holdings without selling the property or triggering capital gains tax. A cash out refinance replaces an existing mortgage with a larger one, and the difference, the equity you're pulling out, is delivered to you as cash at closing with no income tax liability. This strategy is particularly powerful for investors who purchased properties years ago at a much lower price, as they extract significant equity that represents decades of appreciating completely tax-free as a loan. The interest on the new mortgage may be deductible against rental income if the property is an investment property, further improving the after-tax economies of the transaction. One important consideration is that cash out refinancing increases the debt load on the property, which means the property's cash flow may decrease as mortgage payments rise. Investors must model the deal carefully to ensure the property still carries positive cash flow after the refinance. In combination with the 1031 exchange strategy discussed earlier, cash out refinancing allows a real estate investor to access wealth from an existing property while keeping the equity that remains fully deployed in appreciating real estate. So a cash out refinance lets real estate investors access and build up equity as tax-free loan proceeds while keeping the appreciating asset intact and potentially deducting the interest expense. You know what I'm saying? And that's what a lot of the real estate people doing. They pull in the equity. They'll get the property, refinance it. I mean, probably put some money in it, make the property value go up first, because you gotta get the equity. So you gotta appreciate the property. The forced appreciation, you just invest in it, upgrade it. You know what I'm saying? Renovate it. Once you do that, the asset value goes up. Now you get an evaluation on the property value. Once you get that higher value amount, then you go refinance the property, right? And now when you refinance the property, you pay off the past loan or past mortgage, whatever that was. You go ahead and pay that all the way off, and you take the profit. You see what I'm saying? You take the profit. And what they like to do is take that profit and throw it into another property or whatever and keep. But that's another video. You know, I'm gonna give y'all that one. We back to the buy, borrow, die though. Build this wealth. All right, back to it. Now, the die phase, transferring generational wealth with zero tax. This is the most important part. Now you understand all the other stuff, but this right here, this is what you got to get into. The stepped up basis, the most powerful tax break you've never used. Understand, it's the most powerful. The stepped up basis provision codified in IRC section 1014 is arguably the most generous tax benefit available to investors who hold appreciating assets until death. And yet most Americans are unaware of how it works or how to plan around it. When an asset is inherited, the inheritor's cost basis, the price used to calculate the future capital gains, is reset to the asset's fair market value on the date of the original owner's death, regardless of what the original owner paid for it. This means that if you purchase stock for $50,000 that grew to $800,000 by the time your death, your heirs inherited at a basis of $800,000 and owe zero capital gains tax on the $750,000 of appreciation that occurred during your lifetime. The stepped up basis applies to the assets held in taxable accounts, including stocks, mutual funds, ETFs, real estate, and business interests, but does not apply to pre-tax retirement accounts like traditional IRAs and 401ks. Married couples can utilize the unlimited marital deduction to pass assets to surviving spouses' estate tax-free. In community property, states offer an additional advantage where both halves of the community property receives a stepped up basis upon the death of one spouse. Understanding this provision is not just about dying well, it changes how you structure your entire investment strategy while you are alive. So the stepped up basis at death wipes out the lifetime of capital gains tax liability. The more you the more your assets appreciate and the longer you hold them, the more powerful this benefit becomes. So it's gonna wipe out the capital gains tax liability, you know what I'm saying, over time. So it's gonna reset like it never got taxed, like it's never gained when it's passed. Once you die, it's passed. They don't have to pay all the taxes that you owe from when you bought it and it grew. And like if you sell it, you got to pay these taxes. But once it passed, when you die, that goes away. They don't have to pay no taxes. There's no tax. It's whatever that market value is. That's what they got it at. See what I'm saying? They didn't hold it and appreciate it and on a gain. They didn't gain nothing. You see what I'm saying? Now, estate tax fundamentals. How much can you pass tax free? How much can you do tax free? All right. While the stepped up basis eliminates capital gains tax at death, very large estates may still face the federal estate tax, which applies to the transfer of wealth above the certain exemption threshold. As of 2024, the federal estate tax exemption is $13.61 million per individual, or $27.22 million for married couples using portability, meaning the vast majority of the Americans will never owe federal estate taxes. Assets above this exemption are taxed at rates up to 40%, which makes estate planning critical for high net worth individuals whose estates approach or exceed the exemption. Importantly, the current exemption level is scheduled to sunset at the end of 2025 and revert to approximately $7 million per person, adjusted for inflation, unless Congress acts, which could dramatically expand the number of estates subject to this tax. State level estate taxes add additional complexity, with some states impose their own estate taxes at much lower exemption thresholds. Massachusetts and Oregon, for example, impose estate taxes starting at just $1 million. Proactive planning using strategies like irrevocable trusts, annual gift exclusions, and family limited partnerships can reduce the taxable estate significantly, and the time to implement these strategies is well before they are needed. So most Americans will never owe federal estate tax, but the 2025 sunset of the current high exemption could create new exposure. Know your estate's value and plan proactively. You know what I'm saying? Trust, gift, estate planning tools that protect your legacy. So now we're just gonna get into what you need to do and ways to protect this money, this legacy, whatever you got, this wealth. For estates approaching the federal exemption threshold, at a suite of estate planning tools can dramatically reduce the taxable estate while preserving the accelerating wealth. Transfers to hires. The annual gift tax exclusion allows any individual to give up $18,000 per year per recipient in 2024 without triggering gift tax or using any of their lifetime exemption, meaning a married couple can give $36,000 per year per child or grandchild entirely tax-free. Irrevocable life insurance trusts, or ILITs, allow life insurance proceeds to pass to their heirs outside of their taxable estate, providing a tax-free debt benefit that can cover estate tax liability or serve as a standalone wealth transfer. Intentionally defective grantor trusts, or IDGTs, allow an asset owner to sell appreciated assets to a trust in exchange for a promissory note, moving appreciating out of the estate while the grantor continues to pay income taxes on the trust earnings. effectively making additional tax-free gifts to the trust. Family limited partnerships and family limited liabilities companies allow businesses to invest allow businesses or investment assets to be transferred to hires or at a discount valuation, reducing the taxable estate while consolidating family wealth management. These tools are not exclusively for the ultra wealthy, and family with a growing investment portfolio, rental estate, or business should review their estate planning with a qualified estate attorney every 3 to 5 years. I'm sorry, y'all. My voice getting a little, my throat getting a little scratchy. All right, let's get back in it. Annual gifting, irrevocable trust, and family entities are key tools to reducing a taxable estate. Begin estate planning well before you need it to maximize the benefit. So those are things you're gonna need to implement if you above this threshold. You're gonna have to move this money and get it tax free. You know, you're gonna have to try to do some of those. Now, build your buy, borrow, die action plan from strategy to execution. How we gonna do it? Translating the buy, borrow, die framework from the theory into a personalized action plan requires 5 sequential decisions that align your current financial position with the long-term strategy. First, assess your current assets based on and determine what percentage is held in taxable accounts versus tax advantage retirement accounts. Then begin systematically shifting future savings towards taxable and brokerage accounts, holding growth-oriented, low-dividend assets. Second, establish your borrowing infrastructure before you need it by opening a pledged asset line of credit with your brokerage or identifying a lender who offers real estate-backed lines of credit so the mechanism is in place when you choose to use it. Third, meet with a CPA who specializes in advanced tax strategy to review your current tax situation, identify immediate opportunities to reduce taxable income, and model the long-term tax impact of the buy, borrow, die strategy on your specific situation. Fourth, engage in an estate attorney to draft or update your will. Establish any necessary trust and ensure your assets are titled correctly to maximize the stepped up basis and minimize estate tax. Fifth, commit to a review cycle annually with your CPA for tax optimization and every 3 years with your estate attorney to account for changes in tax law in your personal network. This strategy is not a one-time decision. It is a living system that requires ongoing management and adjustment as your wealth grows. So build your buy, borrow, die action plan across 5 steps. Restructure accounts, establish borrowing tools, engage in strategic CPAs, create an estate plan, and review everything annually so that you can keep the strategy implementing and doing what it's there to do. And that's how you build generational wealth and pass it on without paying taxes. I hope y'all caught the gem. I hope y'all got the wisdom. I'm going to see y'all next time. This is Chasing Wisdom Podcast. I'm going to catch y'all on the next one. Peace.
This is Chasing Wisdom. Real life, real money, real faith. I came up with a prayer and a plan. Kept my name on the line. This is Chasing Wisdom.
Real life,
Real money.
real faith.
I've been counting every step. Now I'm pressing through the noise. Hands up when the truth hit. I was built for this choice. This is chasing wisdom.
Real life.
Real money, real faith. Fade it out, then cut it clean. Chasing wisdom.